Over $100 million. That is the average size of a real estate syndication deal that everyday investors are quietly participating in right now, without ever signing a deed, managing a tenant, or unclogging a single drain. In the next 10 minutes, you are going to discover exactly how real estate syndication works, why it has become one of the most powerful wealth-building strategies for passive investors, and the one critical risk that almost nobody warns you about before you wire your money. By the end of this video, you will understand a strategy that was once reserved exclusively for ultra-wealthy insiders, and you will know whether it is actually right for you. Stay with us, because the answer might genuinely surprise you. Real estate syndication is not a new concept. It dates back centuries, but its modern form took shape in the United States during the mid-20th century. The basic idea is elegantly simple. A group of investors pool their money together to purchase a property or portfolio of properties that none of them could afford or would want to manage on their own. Think of it like a private real estate fund, except the assets are tangible. We are talking about apartment complexes, commercial office buildings, self-storage facilities, industrial warehouses, and even large retail centers. The structure formalized significantly after the Securities Act of 1933, which established how private investment offerings must be disclosed and regulated. Today, most real estate syndications operate under SEC Regulation D, specifically Rule 506(b) or 506(c), which allows sponsors to raise capital from accredited investors without going through a full public offering. This legal framework is the backbone of the entire industry, and understanding it matters because it directly affects who can participate and how. Historically, syndication was the domain of institutional players, pension funds, private equity firms, and family offices with tens of millions of dollars to deploy. But over the past decade, technology and regulatory changes have cracked the door open for individual investors. Crowdfunding platforms like Realty Mogul, CrowdStreet, and Equity Multiple have brought syndication deals to everyday accredited investors with minimums sometimes as low as $5,000. That shift has fundamentally changed who gets access to these types of returns. So how does a syndication actually work in practice? There are two primary roles. The first is the sponsor, also called the general partner or GP. This is the experienced operator who identifies the deal, negotiates the purchase, secures financing, manages the asset, and executes the business plan. The sponsor brings the expertise, the network, and the day-to-day labor. The second role is the limited partner, or LP. That is where most individual investors sit. Limited partners contribute the equity capital, meaning the cash, in exchange for a share of the profits. They are passive. They do not make operating decisions. They simply invest and receive distributions. But here is what nobody talks about: the sponsor almost never uses their own money to buy the building. They typically contribute somewhere between 5 and 20% of the equity themselves, then raise the rest from limited partners. That means if you invest $50,000 into a $10 million deal, you might own 0.5% of a property you will never set foot in to manage, but you are entitled to your proportional share of rental income and any profit when the asset sells. The financial structure of these deals is where things get genuinely interesting. Most syndications use what is called a preferred return. This is a threshold return, commonly 6 to 8% annually, that limited partners receive before the sponsor takes any profit split. After that preferred return is satisfied, profits are split according to what is called the waterfall, which might be 70% to limited partners and 30% to the sponsor. Some deals use an 80-20 split. Others get more complex with multiple tiers. Always read the private placement memorandum, the PPM, carefully before committing any capital. Returns on syndication deals historically range between 8 and 15% annually, including cash flow and equity appreciation. Some value-add deals in booming markets have returned significantly more. A 2022 study by Preaching found that private real estate funds, which operate similarly to syndications, outperformed public REITs over a 10-year period on a risk-adjusted basis. That data point alone explains why sophisticated investors keep coming back to this asset class. Now let us talk about deal types, because not all syndications are created equal. The two most common strategies are core plus and value-add. A core plus deal involves a stabilized, already performing property where the goal is steady cash flow with modest appreciation. Lower risk, lower reward. A value-add deal involves a property with problems, high vacancy, deferred maintenance, below-market rents, where the sponsor plans to renovate, reposition, and significantly increase the property's value before selling. Higher risk, higher potential reward. There are also opportunistic deals, which involve ground-up development or highly distressed assets, and these carry the most risk of all. Equity multiples are another way to measure syndication performance. If a deal projects a 2x equity multiple over 5 years, that means your $50,000 investment should return $100,000 total, including all distributions and your share of the sale proceeds. A 2x equity multiple over 5 years translates to roughly 15% annualized returns, which is exceptional compared to the long-run stock market average of about 10%. But here is the question every serious investor should ask before signing anything: what happens when the deal goes wrong? And deals do go wrong. Interest rate spikes, like those seen between 2022 and 2024, caught many syndication sponsors off guard. Deals underwritten at low floating rates suddenly faced dramatically higher debt service costs. Some sponsors were forced to do capital calls, asking limited partners to inject additional cash or risk losing their equity entirely. Others sold assets at a loss. The National Council of Real Estate Investment Fiduciaries reported that commercial real estate values fell by over 15% between 2022 and 2023, and syndication investors in overleveraged deals felt that pain directly. This brings us to due diligence, the single most important thing a limited partner can do. Vet the sponsor rigorously. How many deals have they completed? What were the actual returns compared to projections? Do they have a full cycle track record, meaning they have bought and sold deals, not just acquired them? Review the PPM with a real estate attorney. Understand the exit strategy, the debt structure, the assumed cap rate at sale, and the assumptions baked into the underwriting model. If anything feels rushed or opaque, walk away. Liquidity is the other major factor that separates syndications from public investments. When you invest in a REIT on the stock market, you can sell your shares in seconds. With a syndication, your capital is typically locked up for 3 to 7 years. There is no secondary market for most LP interests. You cannot withdraw early if life changes. This illiquidity premium is part of why the returns are higher, but it also means you should only invest money you can truly afford to leave untouched for the full hold period. Tax efficiency is one of the genuinely underappreciated benefits of real estate syndication. Limited partners receive a K-1 tax form each year, which often shows paper losses due to depreciation even when you are receiving cash distributions. This means you may be collecting 6% cash-on-cash returns while showing a taxable loss on paper, offsetting income from other sources. Bonus depreciation, under the current tax code, has allowed sponsors to pass through accelerated depreciation to investors in the early years of a deal, creating significant tax shelter. This is one of the features that makes real estate syndication particularly compelling for high-income earners in the 32% or higher tax brackets. The future of syndication is evolving rapidly. Tokenization of real estate assets using blockchain to fractionalize ownership is beginning to enter this space, potentially offering more liquidity and lower minimums in the years ahead. Regulation A+ offerings have also allowed non-accredited investors to participate in certain deals, broadening access further. The market is growing, and as it grows, the sophistication required to navigate it grows right alongside it. Before you go, if you learned something valuable today, hit that like button right now. Subscribe to Realty Pulse for a brand new video every single day. We will see you in the next one.